The majority of companies in the S&P, after all of these tariff tensions, still look to be overvalued. That is why today we're focusing on 10 with a forward valuation below 15. That is what you see in the green. Now we're going to get straight into number 1 of 10. We're going to discuss why we believe it's undervalued, our own valuation as well, and we're not going to spend more than a couple of minutes on each one of these. Getting straight into it then, number 1, the semiconductor Qualcomm, down 18% over the last year. Year to date, down around 9%, but if you've been a longer term shareholder over the last 10 years, you would be up 105%, nearing the same as the S&P during this time, trading near its 52-week low. We have a buy signal from both Seeking Alpha as well as Wall Street, and if we get straight into the valuation with a forward P of 12, that is below the 5-year of 15.3, so our first severe undervaluation signal. But we get another one, which is dividend yield theory, telling us a company is undervalued when the current yield sits above the 5-year, 2.55 above the 2.12. So for Qualcomm right now, 2 severe undervaluation signals, and that's reconfirmed when we take a look at this model. Now remember, we are going to put it through ours very shortly, but the blue tunnel does signal the expected fair price. Right now we see disparity between where the company is trading at and even the lower end. The first time over the last 12 months, that is again another undervaluation signal, giving us 3 out of 3, meaning we should take some further consideration into the company. And as we said, we're making this episode fairly brief. Our intrinsic price, $202, purely the average of these 4 models that you see on screen. Now, when we do our deeper dives into these companies, we take a closer look. We also discuss the inputs and the outputs for each one of these models. Today, though, the average at 202 with the current price at 139 will give us a very large MOS. Remember, we start off with 10%, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for Qualcomm, a buy up to $182, then we keep going till it's near the current trading price. And in essence, for this company, we see a 30% MOS up to $141, with Wall Street themselves a price target $200 over the next year. They see 44% upside. So give us your thoughts. Qualcomm, buy, hold or sell, 30% MOS, 44% upside. We then move on to Micron Technology, which has been battered down 41% over the last year. Year to date, down 15%. Over the last 10 years, slight outperformance of the S&P, up 146%, trading similar to Qualcomm near its 52-week low. Quite a large pullback, in fact more than 50% from its all-time highs, but we do notice a strong buy from Wall Street, a buy from Seeking Alpha, and whilst we aren't doing a deeper dive into the company, when we typically do take a look, we can see very favorable metrics on the growth and the profitability that both come in at an A+. We also note the forward P of 8.3 is below the 5-year rolling of 12.3, so a severe undervaluation signal, and another one noted with the yield of 0.64 above the 5-year average. And when we do take a look at the blue tunnel, we also want to point out, always good to see it increase over the longer term. Realistically, any company you're invested in or you're considering to add, you want them to be worth more over time, and we can see disparity between the lower end and where the company sits. So Micron, similar to Qualcomm, does look severely undervalued. Now our intrinsic price today gets to $124, derived from the DCF model. We can very briefly show you how we got this, but we have the free cash flow year on year. Average growth quite large, although it is fairly skewed given it has gone from negative to positive for a number of years. Moving forwards, we've gone 20%, but as always, we do have on a DCF model a low, medium and high, 15, 20, 25, which are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's from Micron or any others, but based on 20% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. We get to 124, which indicates 72% upside, but as always, we'll show you full transparency. At the 15% point, $90, and at 25, for those that are a lot more bullish, $169, indicating 135% upside, more than a double from the current value. Now, as we said, we typically do take through the median rate on the channel at 20% today, and when we take a look at the margin of safety, it will be quite significant for MU at the current value. In fact, as we keep on going, you are getting around 40% up to $74, $75. Wall Street themselves incredibly bullish. They see this at $130 over the next year. That in turn translates to 81% upside. Now, will also highlight for those that believe it should be lower at the 15% point, what is the MOS, and in fact there is one still fairly sizable. You're getting at least 20% with Wall Street, as we said, very bullish, perhaps one that is on your radar, but do give us your thoughts. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a copy of 35 undervalued stocks for the month of April. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet released just this morning running through a list of stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the next stock, which is AbbVie, up 10% over the last year. Year to date, pretty much flat. Over the last 10 years, outperforming marginally the S&P, up 169. Trading towards the lower end of the 52-week range, a double buy from both Seeking Alpha as well as Wall Street, although we can in fact see here the opposite of the previous two, where the forward PE does sit above the 5-year and the yield does sit below. So whilst those showed us an undervaluation signal, purely on these models, AbbVie is looking overvalued, and that is also the conclusion when we take a look at this model. We do see disparity at the upper end, but as always, we don't look at these models in pure isolation, and when we get to our own valuation, our intrinsic price is $204, where you will get a nice MOS for what we do believe is a high quality company. In fact, you're not getting 10% just yet, although only a few dollars shy. So for AbbVie, a near 15% MOS, Wall Street themselves $216 over the next year, which translates to 22% upside. And give us your thoughts, this is one we in fact do hold in our own portfolio. We then move on to ELV, which is down 12% over the last year. Year to date, however, up 19%, massively outperforming the S&P. The same conclusion over the last 10 years, trading in the mid to lower end of the 52-week range with a strong buy from Wall Street and a buy from Seeking Alpha. And we also notice the undervaluation signal, 12.7 forward PE below the 5-year at 13.9, with an attractive yield at 1.56 above the 5-year at 1.23. And the conclusion is fairly similar when we take a look at this model, undervaluation all round, although we do see it slightly towards the bottom end of this blue tunnel. Again, definitely one that does look like further consideration should be had. And our intrinsic value comes to just below $500. When we take a look at a margin of safety, you are in fact getting not 15% just yet, sitting somewhere between 10 to 15, with Wall Street themselves fairly bullish, $510 price target, 17% upside. We then move on to Caterpillar, which is down 18% over the last year. Year to date, down 18%, and over the last 10 years, outperforming the S&P, up 253%, trading towards the lower end of the 52-week range. Interestingly, all three analysts, Seeking Alpha, Wall Street, and Quant, giving this company a hold, although we do notice undervaluation, forward P pretty much bang on 15, below the 5-year of 17, and the yield not too dissimilar from the 5-year at 2.06, and we do get an undervaluation signal. In fact, for the first time over the last 12 months, we have noticed disparity, so Caterpillar does look undervalued. Now, when we run it to our own model, the intrinsic value, and again, remember, you can grab a copy of this model by clicking on the pinned comment below, comes to $387. When we look at the MOS, you are getting a fairly sizable amount. 25% would be a buy at 291. Right now, though, between 20 to 25, Wall Street, their estimations, even with their hold rating, 390 1 year from now, translating to 31% upside. We then move on to the Dividend King, which did have a fairly decent earnings just not too long ago, with a dividend increase as well. They're up 4% over the last year. Year to date, up 6%. Over the last 10 years, up only 52%, now trading in the mid to lower end of the 52-week range, and a double buy from both Seeking Alpha as well as Wall Street. We get an undervaluation signal, forward P below 15 with the 5-year just above 16, and one of the highest yields they've offered over the last 5 years at 3.4%, above the 5-year average at 2.75, and another undervaluation signal here, slightly below that bottom end, disparity is noted, undervaluation. And our intrinsic price is $179. You're getting at least 10% MOS up to 161. Right now, though, it is sitting around the 15% point. Dividend King, recent dividend increase today as well, but Wall Street with their price target on the lower end, $172, upside of 12%. We then move on to Dell Technologies, battered over the last year, down 27%. Year to date as well, down 26%, losing more than 1/4 of their market cap in 2025 alone, and over the last 5 years, outperforming the S&P up 112%, trading towards the lower end of the 52-week range, a massive drop from their all-time highs at $180, with a triple buy rating from every single analyst. And if we were to do a deeper dive, you can see looking fairly attractive across the different gradings. We also notice the forward PE 9.2, slightly below the 5-year average, with the yield also slightly above, so it does look like possible undervaluation signs. And in fact, this model is telling us pretty much that. Something you always want to see is a company with the blue tunnel increasing over time, and in fact the current price sitting below, so nice to see that from Dell Technologies, an undervaluation one. Now, intrinsic price comes to $137. When we do take a look at an MOS, probably quite obvious and clear to note, you are getting quite a substantial one at 40%, not there yet, but not far off for Dell Technologies, at least 35% up to $90. Wall Street, very bullish. We got the triple buy rating, $137 price target, 61% upside. Dell Technologies, have you been buying it recently or maybe on your watch list? We then move on to one for dividend lovers, Diamondback Energy, ticker symbol FANG, down 38% over the last year. Year to date, down 22%. Over the last 10 years, it is up around 60%. Bear in mind though, this is if you bought 10 years ago. Today, for example, if you did buy the COVID lows at around $18, you would be up quite significantly at that as well. In terms of where it sits, well, towards the lower end of the 52-week range, we do get a double buy rating as well from Seeking Alpha and Wall Street, with a forward P sitting at 9, slightly above the 5-year average, but we also get the yield above the 5-year, so two conflicting things here, one undervaluation, one overvaluation. And when we take a look at this model, it is pretty much sitting around the mid to upper end of the blue tunnel, so reasonable signal. Our intrinsic value though, coming to $183, will give quite again another substantial MOS. As we do in fact keep on going, you're getting bang on 30%, a yield above 5%, Wall Street's price target over $200, giving possible upside of 60%. We then move on to Applied Materials, down 30% over the last year. Year to date, down 11%. Over the last 10 though, massive outperformance of the S&P, up 565, trading towards the lower end of the 52-week range. Double buy from Seeking Alpha and Wall Street, a forward P sitting around 15, below the 5-year of 18, a yield of 1.3 above the 5-year of 0.89, and we also get a third undervaluation signal with the disparity on the blue tunnel model. Now, intrinsic price comes to $229, so again for this company, AMAT, you are getting a substantial MOS. In fact, as we keep on going in the episode today, you're getting at least 35% up to $149. Wall Street themselves, very bullish, $205 price target, they see 43%. Applied Materials, buy, hold or sell. We then move on to the Walt Disney Company, down 24% over the last year. Year to date, down 23%, not a great start to the year. Over the last 10 years, well, also in a downward trend, negative 22%, but again, will depend at which point you bought. Although if we do take a look at the COVID lows, it's pretty much sitting there right now, so you would have seen around 4 years of gains wiped out. Although its all-time high wasn't that far off the COVID lows, $197 in 2021, and then we do see it pretty much come all the way down to the current levels, trading near its 52-week low with a double buy from Seeking Alpha and Wall Street. We also see the forward P of 15.7, well below the 5-year of 23.1. That is a massive, severe undervaluation signal, and although they've only recently restarted the dividend, 1.17 above the 5-year at 0.89. And we can also see it, although on this model, pretty much telling us for the majority of the last year, this company has been trading at a severely undervaluation level, and our intrinsic value today at $108 derived from the DCF model. We've used the lower rate at 8%. With that discount rate, you can see 108 giving 27% upside, but if you believe 10% to be the most appropriate, it would be higher, 52%, and at 12%, 79% upside. Again, it is fairly subjective, will come down to your own investment thesis, but if we take a look at the lower rate, you are, again, very similar for the last few companies, getting quite a substantial margin of safety, 20%, Wall Street extremely bullish, their price target $128, 51% upside. Walt Disney, buy, hold or sell, and give us your thoughts about these 10 stocks today trading below the 15 forward valuation. Is it some that you are considering or perhaps not, and let us know why. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and as always have a great day. We'll see you all on the next one.